You're listening to Colorado Chamber Office Hours, a podcast that explores what matters most to business. I'm your host, Ed Sealover, Vice President of Strategic Initiatives for the Colorado Chamber of Commerce and editor of the Sum and Substance. Let's get talking. Welcome back, everyone. And with tax day looming on Wednesday, we figured this would be the perfect week to talk about a four-bill tax package that has begun its advance through the legislature and could impact almost everyone who is listening in one way or another. And to discuss that package, we have with us today Caroline Nutter, who is the policy manager at the Colorado Fiscal Institute and one of the primary individuals who helped legislators to craft this package. Caroline, welcome to the podcast.
Thanks for having me, Ed.
Now, we're going to get into details of each of these bills individually in the wonky way that one can only talk about tax bills. But I first want to ask you the broader question that I think that you all contemplated as well before helping people come up with this package. Why do you believe we need this tax reform right now? And what will these four bills as a whole do to impact the financial conditions of a state that's facing chronic budget shortfalls and tax breaks that turn on and off because of those shortfalls?
Thank you. That's a great opener because one of the primary reasons why we wanted to advance this package of bills is exactly because of these tax credits that are turning on and off. So in 2024, CFI, along with partners from Garrity Community Ventures, really led the charge in creating something called the Family Affordability Credit. That credit is a refundable tax credit. And it impacts 48% of Colorado kids, up to families making up to $100,000. So it's a very significant and meaningful credit. We put it into place with a trigger on it that is tied to revenue growth, meaning that if revenue growth falls here in Colorado, the credit would be triggered off. And when we put that trigger on in 2024, we did not anticipate revenue growth to fall as precipitously as it has in the last year, really driven by the HR 1 tax bill that was passed in Congress last summer, also known as the One Big Beautiful Bill Act. And what that did is it ended up turning off the family affordability tax credit for 3 years, which for families that have gotten the credit for 2024 and 2025, having that sudden cliff of turning off is pretty significant. So that was really our thinking behind crafting these bills. 3 out of 4 of the bills will make tax changes and use the revenue from those tax changes to fund a permanent version of the credit so that it doesn't turn on and off depending on revenue growth. There's a permanent underlying base credit. And then the other tax bill that is in this package is a cleanup bill. What I will say regarding the budget in terms of all of these bills is that they are all actually revenue neutral. So unfortunately, they don't do a lot to alleviate the budget woes of our current budget climate at the moment.
And I'll just add, when you say revenue neutral, of course, what we're talking about here is these are all going to create substantial revenue for the state, but they are not going to go to the budget. They are specifically going to this new tax credit that's essentially a replacement for the family affordability tax credit. So it's good primer for kind of why and where this money is going. So with that said, let's talk specifics here. And I should mention all 4 of these bills have passed out of the House Finance Committee and are waiting for their hearings in the House Appropriations Committee, along with a ton of other bills that have been backed up there, all of them which were waiting for last week's passage of the budget through the House. So first up, House Bill 1221 alters 2 long-standing tax breaks, including one dealing with net operating loss. Can you tell us about what this does and why you've chosen these?
Absolutely. So the first part of this bill has to do with something called the executive compensation limitation. So generally in the course of businesses are able to deduct their compensation for their employees, wages and salaries. In 1993, President Clinton passed a limitation on the extent to which businesses can deduct the salaries of their top paid officials, so their C-suite, basically. And this only applies to publicly traded corporations. And that limit was established back in the 90s at $1 million. What this bill would do is it would reduce that limit to $250 million. So that's currently, as it stands, what the bill is doing. In terms of the net operating loss deduction, like compensation, deducting losses is something that businesses are able to do across the country. It's a pretty ubiquitous business expense deduction. In Colorado right now, we have two leverage points by which we limit the net operating loss deduction. The first one is that you can't deduct your entire taxable income. You can't bring your taxable income all the way to zero using just the NOL deduction. You also can't carry forward that deduction indefinitely, which is how the federal government has done it since 2017, since the TCJA. And we currently have a limit on carry forwards for net operating loss deductions at 20 years. And so what this bill does is it would reduce the limit that you can reduce your taxable income by. That's currently 80%. So you can reduce 80% of your taxable income. We're reducing that to 70%. And then on the carry forward, we are reducing that carry forward from 20 years to 10 years.
And let me jump in there because I know this is where a lot of business leaders say, look, the net operating loss structure is very important because it incentivizes research and development heavy startups to invest now, recoup losses in later years, and become profitable. Isn't this going to disrupt that formula?
That's a great question. So, when we were crafting this bill, we really looked at what a lot of other states in the country do. So, we know that the federal government has this indefinite carry forward period, but other states in the country are kind of all over the map in terms of how they deal with net operating loss deduction. Some of them just have a cap, some of them don't have a carry forward, some of them have a carry forward of 8 years. Generally, the general median, I would say, for net operating loss is between 8 and 15 years. And so we thought 10 was kind of a good middle ground between those two. But that was kind of our thinking here.
Okay. Now, on to House Bill 1222, speaking of federal laws here.
Yes.
This bill decouples a quartet of recently added or expanded federal tax breaks from state policy. I guess I'll go high level with you here, in kind of rapid speed fashion. What are you looking to decouple and why?
Yes. So the four pieces that we're looking to decouple from, two of them kind of have to do with each other, so I can group them together. They're both part of the 168 statute. Internal Revenue Code statute. So 168K is the bonus depreciation deduction. And what that allows is we have a depreciation deduction already. It's 179. But a bonus depreciation deduction says that on top of that, you can also deduct 100% of your business expenses in that year. So this is something that has been kind of on the tax horizon. This was in the TCJA as well, but the TCJA did that for only 1 year and then phased that down. And what HR 1 did is it actually made that 100% bonus depreciation immediate expensing permanent. The second piece of that is another piece of 168, and that's the same 100% immediate expensing, but just for certain qualified property, really focused on manufacturing and refining. And then, so those are the two that we're proposing to decouple from. The first one is really that's the largest in terms of dollars. The third piece is a research and development deduction that the TCJA actually changed to be a 5-year amortization. And HR 1 brought it back to 100% immediate deduction. And so we're going back to the TCJA 5-year amortization. And then the last one is a business interest piece, and we're not changing it the way we're changing the other things, because what HR 1 did to the business interest deduction was it allowed more things to count for your taxable income. And so it kind of changed just the qualification and the threshold by which you take the deduction. And so we just want to return to what it was before, which is not taking into account all those extra things for your taxable income. So it functionally decreases the deduction.
And for everyone who's not a CFO who's saying, okay, what does this all mean? Let's put it this way. The fiscal note on the two bills we've discussed and the one we're about to discuss are about a combined $560 million. So these are serious tax breaks here that go to the bottom line of businesses. That obviously the debate is, should they be going to the bottom line of businesses? Should they be going to the family affordability tax credit? Let me go on to the third one here because I think this one's a little bit more relatable. The House Bill 1223 modifies several state tax breaks, though I think it's fair to say the change that is drawing the most attention is the elimination of the sales tax exemption on downloadable software. Why go after that?
Yes. So that's a great question. So the downloadable software exemption was passed in 2011. And that was when a lot of state economies were dealing with digital goods. And so there was this movement, that this kind of bifurcated movement in states where some states decided that they wanted to not tax digital goods and some states decided that they did want to tax digital goods. And the way that movement has gone in the last 10 years since 2011 is that most states have moved to taxing digital goods, including downloadable software. So we're only one of 13 states that currently exempts downloadable software from taxation. We do apply taxes to other digital goods, like when you buy an audiobook or a digital subscription or things like that. And so we really we have felt for a long time that the downloadable software exemption doesn't put us in line with the movement of what states are doing when it comes to digital good taxation. But also it creates this weird inequity between taxpayers where if you're someone who goes to Best Buy and you purchase Microsoft Office, you pay sales tax on that good. However, if you download Microsoft Office from the internet, you do not pay sales tax on that good. And so there's this weird inequity between taxpayers that are doing similar behaviors or the same behavior. And that is something that is kind of a red flag for CFI generally, is we want to make sure that there's equity between taxpayers that are doing similar behavior.
And in case anybody's saying, wait, what's the other side of this? Don't worry, that's coming up after this conversation. Lastly, and is House Bill 1289, it is a 32-point monster that makes a ton of changes, though I will say most are non-controversial. There is one big change to what is known as the 80-20 rule that impacts local affiliates of international companies. I am actually not going to ask you to get into the details of this.
Okay.
This is so in the weeds that I think we could spend an entire 10-minute conversation just explaining it. But in the big picture, why are you looking to make a change that could affect companies that are affiliates of international companies there?
Yes, so that's a good question. So many states have moved to close this rule because it does create weird incentives sometimes for companies that have subsidiaries to fill them with 81% of foreign income and then that makes that subsidiary non-taxable for state purposes. And so there's been a lot of movement on the 80-20 rule recently. I know Illinois had a big case about it where they recently won their case against Pepsi that was using the 80-20 rule in a way that was promoting tax avoidance. So it's one of those things where it's not always promoting tax avoidance. It's not necessarily one of those loopholes that is a tax avoidance loophole, but there have been companies that have used it in a way that courts have ruled is shady. Right. And so that's just something where we want to take away the incentive to do that and just go to water's edge election, which most other states do.
We will get back into that with our next guest as well. Caroline, this has been fantastic. It's a big picture dive into a lot of policies that people may not even know exist that have a major impact on the state budget here. And I appreciate this, and we'll be eager to see where these bills go in the coming weeks.
Thank you.
And now we welcome onto the podcast Phil Horowitz, the former director of the Office of Tax Policy Analysis for the Colorado Department of Revenue, who now works as the state and local tax director for the firm Baker Tilly, and also sits as the chairman of the Colorado Chamber of Commerce Tax Council. Welcome, Phil.
Thank you very much. Pleasure to be with you guys.
So just as I did with Caroline Nutter, I want to start before we get into the gory details of these tax bills by asking you, what do you think their cumulative impact could be on Colorado's tax system or business environment, or what should people be thinking about cumulatively as we look at these bills?
Well, it's a great question, and the chamber recently published, and the governor signed on to a letter talking about the business environment in Colorado, and one of the fundamental things that it talked about was the constant change that makes it so hard to do business in Colorado, and the fear that that is going to, further discourage people from starting new businesses, from moving businesses to Colorado. And I think that's a fair point. Colorado needs consistent tax policy, and and something that the business community can expect over time and expect to stay relatively stable over time. Now, it's not exactly always in the control of the state, right? We've had huge changes at the federal level with 2017's TCJA, and then the coronavirus CARES changes. Those are big federal changes. Before that, we hadn't had this kind of change since 1986, and so 86 to 2012 is a pretty long period of stability from a federal perspective, and then pretty big changes in 2017 and again in 2025. So it's not fair exactly to blame all of this on the state, but the state's not helping, and the state could help. The state could help keep things stable by not making constant changes all the time. And I think that's part of the story here. And then the other part of the story that I think is kind of critical is that all of the bills that that you asked me to think about ahead of time are really, I don't know what to call them exactly, but they tie together the revenue raising elements and the expenditure elements into a single bill. And that, to me, seems extremely poor tax policy, because tax policy should be evaluated in a vacuum, it should be evaluated not exactly in a vacuum, but with respect to the entirety of tax policy, of your revenue raising structure as a whole. But not tied together with the expenditure side of things. Expenditure items should be compared against each other and ranked and funded in accordance with whatever the legislature thinks is the most important ways to spend money. And by the same token, revenue raising should be thought about in a single holistic way, and you figure out where you can raise the revenue you need. And then you do that by the taxes that you have in place, and tweaking those taxes. But to tie revenue and expenditure together overwhelms the revenue aspects of every bill. And I listened to the testimony in House Finance. I testified on a couple of these bills, and in every case, there was nothing that you could say that was going to derail these bills, because the expenditure side carries such momentum, because these tax credits that are being funded are so important to the legislature that the revenue raising mechanism isn't even looked at. Nothing we could have said would have made any difference to any of the legislators, because they care about funding money to children, and that's important. I don't question that, but that should be evaluated against the expenditure side of the House, not against a specific revenue source.
And to that end, I think we'll actually go ahead and kind of separate. Let's not talk about the family affordability credit this creates, but let's talk about the tax policy. Let me start with House Bill 1221. You in particular, I know, have expressed a lot of concern about the impact of limiting the net operating loss deduction. Why is that? What's so potentially harmful about doing that?
So there are lots of things. There are lots of things wrong with tinkering with the NOL, with the net operating loss deduction. At the top of the list is the idea that the whole structure of the income tax is designed to be an income tax over time, and designed to allow a company to lose money in the early years of its existence, and then recover that money over time from a tax liability point of view, and only start paying tax once they have reached income over time, once they've recovered their losses and then started to make income over and above what they've spent in the early years. I mean, a year is an artificial construct by which to measure how much income a company has earned. Really, you care about it over time, not year to year. But, but that's not the way the federal government or any state government works. They need money on a regular cadence, and annually is the way we've structured the income tax. So it has to be viewed on a year-by-year approach. But the net operating loss carry forward is structured so that a company recovers its losses in its early years over time. And so by limiting that period, you are really fundamentally altering the character, the nature of the income tax from an overall income tax to just a snapshot in time that isn't realistic in terms of what a company's income is. So that's one problem. That's only the start of things, right? I care about I practice in an area. I practiced for years and years at the Department of Revenue on the administration side. Now I practice representing taxpayers and working with those taxpayers trying to craft their tax returns. And the disconnect between federal and state is so important. Companies spend thousands of dollars every year on their income tax compliance just on the federal side. And the states should be fairly straightforward, should be fairly easy. And the net operating loss is not a swimming pool you want to play in, believe me. It is a hugely complicated mechanism at the state level, right? Because we piggyback on the federal net operating loss. Well, guess what? The federal net operating loss represents a snapshot over time of a company's total expenditure versus total income around the entire country. And so when a state decides to piggyback off that NOL, which Colorado does for simplicity purposes, and thank God that it does, it's got to take a snapshot. It's got to take a fraction of that NOL that was generated over multiple years previously, and then allocate that or apportion that to the state, to the particular state, to Colorado in this case. And so when you fiddle with that, it's a hugely complicated bundle. It is a Gordian knot. And you can't just take a sword to it and slice off the end of the rope and hope for the best. It's a very poor approach. You have to carefully untangle the strands and figure out, all right, how much of this really should Colorado be allowed, and how much should it take? And this doesn't do that, right? 1221 literally takes a sword to the end of the rope and chops off the skinny end in this case. But it's bad tax policy to do it that way. It really should be a more thoughtful approach to the NOL if you need to raise money in that space.
Speaking of piggybacking on the federal government, let's talk about House Bill 1222, which is the decoupling bill, especially dealing with a number of depreciation schedules. Is this one problematic as well? And if so, why?
So this one, I would say at a high level, this one's easy. This one is a problem because it increases complexity with no net benefit to the state. The state, at the end of the day, has to pay all this money back just in future years. It's robbing Peter to pay Paul, literally. Peter being the future, Paul being the present. Right? Robbing Peter to pay Paul. I think that's right.
Anyway, got it, yes.
In any event, these are all timing issues. These were all timing issues that the Fed cares about at the federal level because you've got to balance, because the freaky nature of Reconciliation Act and the fact that they've got to do this within a 10-year window and all kinds of budget scoring problems at the federal level. The state doesn't have that problem. In this case, all this bill is doing is bringing money forward into the current year by denying those deductions to corporations now, and they have to give those deductions back later, either in years 2 through 5 or in years 2 through 37 in one case. But it's really a poor. The juice is not worth the squeeze, I guess, is what I would say here. The other thing about these deduction bills, about these timing bills, is that the view of the bill is very narrow in that it doesn't recognize that in 2017, when TCJA was adopted, all of these bills were state favorable, because what TCJA did was reduce the federal tax rates, and it used some of the tax base as a pay for those rate reductions. And so the states all benefited because the states don't pick up the federal rate reductions, but they do pick up all of the base increases. And so Colorado was perfectly happy to take all those base increases when they came in 2017. And, I was personally in favor of that because it kept things simple. And I think simplicity is an excellent end in and of itself. But now that we're seeing the reversal of some of those at the federal level, now the state wants to decouple. And it doesn't want to decouple to pre-2017 standards. It wants to decouple to post-2017 standards. When they got the cake, now they want to eat it too. Again, to abuse a terrible metaphor.
I'm actually going to go ahead and skip over HB 1223 just because I think that's a little simpler for most people to grasp. That's the software tax exemption. But I want to dive lastly into HB 1289 and talk about the 80-20 rule and why you in particular think it could be problematic to change the way that rule is implemented here in the state.
So, this is a hugely complicated area of tax law, an area of corporate tax that has to do with how you apportion income across multiple states, and whether your picture is just the United States or whether your picture is the whole world, all of your operations worldwide. And I don't know that one way is particularly better than the other, honestly. I mean, yes, I do. I think if I'm being honest, I have to admit that a worldwide perspective is probably more accurate in terms of you are taking all of the income of a worldwide corporation or a worldwide group of corporations, combining it all together, and then saying, all right, what's Colorado's much smaller slice of that pie? But the price for that increase in a very minor increase in what you might think of as accuracy is a huge increase in complexity, because you are not just talking about, well, let's expand our view. It's not like, to make this particularly timely, it's not like the view of the Earth from the Artemis, where it all looks like one great big blue marble, but in fact it's divided up into hundreds of countries, all of them with different currencies, all of them with different currency transaction rates, whatever the and all of them, many of them with different accounting standards. The U.S. is on GAAP. Most of the rest of Europe is on a different international accounting standard. And, other countries that I'm not familiar with, I don't do a lot of international tax, may be on yet a third accounting standard. And those things all have to be reconciled before you can bring all those numbers together into a worldwide report. And so we're buying a very large increase in complexity for a very small increase in what is arguably accuracy. And so I just think the trade-off is probably not worth it. Overall, I don't think I don't think from a tax policy bill perspective it's a terrible tax policy, but it is a huge increase in complexity for those companies that want to file on a worldwide basis. And I just don't think the juice is worth the squeeze in this case.
Folks, I think this radio episode is going to be worth continuing hours course credit if you are a CPA. Thank you, Phil Horowitz, for joining us and for walking through those. And hopefully we have people watching these as closely as you are to see what this means to Colorado.
Thanks, Ed.
That's it for our interview segment. Now let's take a quick look at what you need to know about the week ahead. That was a lot of information to take in on the tax bill package. So I'll try to keep the preview of this week's 5 bills to watch a little shorter for you. First, after the House successfully passed the $46.8 billion budget bill on Saturday, the Senate will take it up this week. Medicaid programs are still looking at major cuts, much to the consternation of hospitals, and there is still no sign of introduction for the bill that would privatize Pinnacle Assurance, meaning that is very unlikely to be a part of the budget this year. Second, at 1:30 p.m. Monday, the House Agriculture, Water, and Natural Resources Committee is expected, finally, to take a vote on a bill that would make it more difficult for farmers, apartment managers, and others to use certain kinds of rodenticides to stave off rat infestations. Agricultural and business groups, including the Colorado Chamber, remain opposed to this proposal. The vote will take place in House Committee Room 107. On Tuesday, the Senate Finance Committee, meeting at 2 p.m., will take up two bills that seek to slow the rise of homeowners insurance premiums that rose by an average of 18% statewide in 25 in different ways. Senate Bill 49, which was developed in large part by the Colorado Chamber, would allow for the creation of new tax-free savings accounts into which people could put money to save up and buy hail-resistant roofs. Senate Bill 155, meanwhile, would add a 0.5% fee on all homeowners insurance premiums in Colorado to create a $20 million annual grant fund that would distribute money to help residents purchase hail-resistant roofs. Both hearings will be in Senate Committee Room 357. Finally, the House Finance Committee, meeting upon House adjournment on Thursday morning, will hear House Bill 1119, a bill that would permit local governments to implement what is generally called a land value tax in Colorado. This is a tax in which the property and the structure or structures on any given property are valued at different mill levy rates for property tax purposes. This kind of taxation is catching on in urban areas like Detroit, where city leaders are pushing to ensure that vacant or underused properties are developed, and it's also popular with proponents of urban densification, who note the tax rates reflect the highest possible valued use of land, such as replacing surface parking lots in a city with multi-story residential or commercial buildings. However, many business groups like the Colorado Chamber still oppose this idea. The hearing is slated for House Committee Room 112. That's all for this episode of Colorado Chamber Office Hours. Once again, I'm Ed Seelover, Vice President of Strategic Initiatives for the Colorado Chamber of Commerce and editor of the Sum and Substance. I'll keep the conversation going at tsscolorado.com, and we'll see you next time as we explore the issues that matter most to business.